The broadcast is now starting. All attendees are in listen-only mode.
Okay, everyone, we're going to go ahead and get started. Hello, and welcome to our webinar. This program is a part of the Council of State Government's Academy series, a bi-monthly webinar series designed to provide information and training on the most critical issues facing state leaders, including the latest trends in state policymaking and cutting-edge state solutions. Today's program is the third in a four-part series designed to give state policymakers a basic and solid understanding of risk management and insurance and how insurance affects policy decisions. CSG has been excited to partner with the Griffith Insurance Education Foundation on this webinar and a series of other events over the last year and a half on insurance-related issues. We've worked closely with Frank Paul Tomasello, Program Director at the Griffith Foundation, an affiliate of the Institute, to bring you these programs. Frank and I will be moderating today's program. So I'd like to ask Frank to say a few words about our collaboration. Frank?
Thank you, Jennifer. The Griffith Foundation shares CSG's excitement about our collaborative relationship. Our organizations share similar missions, which include a commitment to a nonpartisan, non-advocative academic approach to programming. And this shared commitment is at the core of our collaborative efforts, enabling us to provide an opportunity for public policymakers to gain unbiased knowledge about risk management and insurance. And in a moment, I'll introduce today's presenter, but first, let me send it back to you, Jennifer, to cover logistics for the webinar.
Thanks, Frank. So I'd like to talk very briefly about webinar logistics today. First of all, the webinar is being recorded, so if you miss anything, it will be available in the next couple of days on our website, csg.org/knowledge center. And also, as I mentioned before, this is the third in a four-part series on risk management insurance. Our fourth and final webinar in this series will take place on October 25th, and in order to sign up for that, just go to csg.org. And finally, if the audience has any questions, we welcome them. If you'd like to ask a question at any time, just type it into the dialog box on the GoToWebinar interface, and we'll make sure that our speaker gets it. So with that, I'll turn it back over to Frank.
Thanks, Jennifer. It's a pleasure to be joined today by Dr. James M. Carson, the Daniel P. Amos Distinguished Professor of Insurance at the Terry College of Business at the University of Georgia. Professor Carson earned his undergraduate and master's degrees at the University of Nebraska and his PhD in risk management and insurance from the University of Georgia. To learn more about his academic interests and accomplishments, we invite you to visit the Terry College of Business website. In the hour ahead, Dr. Carson will explore the underpinnings of life insurance, annuities, and health insurance, and he'll do so through the lens of changing demographics in our country as the baby boomers age. Dr. Carson, we thank you for joining us today. The floor is yours.
Thank you, Jennifer and Frank. It's absolutely my pleasure to join everybody here today, and I'm looking forward to spending about an hour talking about three subjects that are definitely some of my favorites. And so as Captain Kirk might say about space, this being our third session in the four-part series, not the final frontier, but we're getting close to the end. And we'll talk about big picture life insurance, annuities, and some health insurance. And so, as you said, Frank, to kind of set the stage, I want to talk a little bit about what's going to happen over the next few decades. And so on the next slide, I think there's a few points about in terms of demographics. And so, and one more slide too, if we can. Over the next 20 or 30 years, as most of you know, the age 65 and over group is going to become a bigger and bigger part of the population as a whole. And so a lot of this, of course, relates to the baby boom generation from the 46 to 1964. And so by the time we get about 34 years or so from now, the number of folks above 65 will be about double the number that we have today. So it'll be close to 90 million. So out of the 320 or so million of people that we have in the country today, as that population continues to grow, the portion above 65 will about double. And so a bigger and bigger portion of that in the above 65 group. And that's a great thing in the sense that people are living longer. But as we'll talk about, that also gives rise to several challenges that tie into what we're talking about today. And so the next slide starts to get into some of these details. And so when you think about a country of, a little over 300 million folks today, and growing to over 400 million over the next few decades, programs like Social Security, programs like Medicare that provide important social insurance benefits, but that are also very costly and that take up, depending on what all you count, but Social Security, Medicare, and a couple other smaller programs gets you up to right around 50% of the U.S. federal budget. And so when you start thinking about more and more people collecting benefits through Social Security and being covered under Medicare, that presents some obvious challenges for funding those programs out of current tax revenue. And so more on an individual or family level, these changing demographics have direct impacts in terms of how families are likely to plan for things like early death, and so that'll tie into our life insurance segment. Healthcare expenses, which again, as you know, there's been quite a bit of change over the last several years in our how we handle health insurance and health coverage and healthcare expenses. And then it also gives rise to the idea or the question of how to retire, when to retire, can I retire, and so on. So Copernicus back in the 1500s was working on a lot of his models and equations, and he worked until basically the day he died. I think around age 70 he was working on one of his mathematical models and worked all the way till the end. And some of us might like to do that. At the same time, it's also pleasant to think about maybe retiring someday, but with longer life expectancies and needing to have funds to cover those expenses during retirement can become a big challenge. So with that as kind of a foundation, let's move into some of the more specific slides related to our big three topics of life insurance, annuities, and health insurance.
Jim, as we transition into those topics, no doubt some of our attendees have heard a bit about insurers that have been designated as systemically important financial institutions, or SIFIs. Wondering if you might take a moment and talk to folks about sort of what that designation means and whether any of those designated as SIFIs are life insurers.
Okay, sure. Good, and I'm very glad to hear that folks are using the question bar, and I definitely encourage those throughout the session. So the SIFI, so Systemically Important Financial Institutions, really a relatively new term, kind of coming out of the Great Recession of 2000, kind of late 2007 to 2009. And as part of Dodd-Frank and a lot of the legislation that was drafted and put into place to at least attempt to get a better handle on what some lawmakers view as trying to get a handle on making sure that our financial institutions aren't, to use the popular phrase, quote, too big to fail. And no doubt we're going to have large institutions, banks, insurance companies, and other types of non-financial firms. The goal is to try to make sure that firms are in a position to not fail, and that regulators are in a position to understand the dynamics of companies, how they work, their finances, related specifically to insurers. So there's a lot of banks that fall under this systemically important financial institution. But for insurers, and specifically life insurers or companies that sell life and health and annuity products, I think the questioner asked, which of the life insurers have this designation. And so at least currently, AIG, so we might think of AIG as a big property insurer, and they are, but they've also got life and health and annuity divisions. Prudential would also carry this SIFI designation, and then GE Capital has got some insurance divisions as well. You might be thinking, oh, what about MetLife? And you're right, the Fed at least initially designated MetLife as a systemically important financial institution, but of course they challenged that designation, and that was upheld. The challenge was upheld, and the latest I've heard on that and have been reading is that the Fed may come back and challenge the challenge. And so at least as of now, MetLife would not be considered a SIFI. So great question, and it ties right into our life insurance portion here at the beginning. And so I appreciate the questions, and please feel free to keep those coming. So, okay, yeah, definitely. Next slide, we'll get into some of the nitty-gritty on life insurance. Okay, so just before we dig into some of the inner workings and mechanics of life insurance, let's take a big picture and just think about why or who might be inclined to buy insurance, life insurance. And so we always want to start off by saying, not everyone absolutely necessarily needs life insurance. As a country, we're probably vastly underinsured, and so not that everybody needs life insurance, but of the people who do need life insurance, most studies would suggest that people are woefully underinsured. And so for the purposes of replacing lost income, so you can think about it kind of in your own situation, if family or others depend on your income, life insurance is probably the easiest, least expensive, pain-free way to, not replace you, of course, but at least the income that is lost if something should happen to you, and you're not around to generate that income for those that depend on it. And so it's really for those that are still around that would miss that income that we would think about life insurance. Other goals, though, that we can fulfill with life insurance is to pay off debts, provide for college education for children or others, for example. If an estate tax bill is likely upon death, then life insurance is often a good way to kind of fund that. It can be a tax-efficient way to do that. For charities or other loved ones, life insurance can work very well. In a business setting, we might want to fund what's known as a buy-sell agreement to provide liquidity for that often small or medium or even larger business. If there's a key person within an organization that would be very difficult to replace and costly to replace, often life insurance can fill an important role in that sense. As well, we'll look at some types of life insurance that have an investment component, and so more of the cash value types of policies that have some tax advantaged features in terms of tax deferral and maybe even tax avoidance upon death, and just for the ability to access some of those investment features might be a reason to think about different kinds of life insurance as well. Of course, it's a little different. This type of coverage is a little different than things like auto and home insurance in the sense that usually we're just limited to one claim in life insurance. So with that, let's move to the next slide, and we'll move into some of the nitty-gritty. So I like to think about life insurance in two broad categories. And the first one, term life insurance. And the term kind of typically refers to a time frame. And so a time period, a term, such as a year, such as 5 years, 10 years, 20 years. And at the end of that term, the policy typically would be renewable. So if you had a 5-year term life insurance contract, you'd have coverage for 5 years, usually at a level premium for that 5-year period. And then at the end of 5 years, you could renew it at what would usually be a higher premium based on your current age 5 years later. The big thing there is you're literally just paying for the risk of death, the mortality charge, and then of course the insurer expenses, but there's no additional premium that would be funneled toward this savings component. So there really is no investment component in a term policy, and in that sense it's you can call it plain, simple, pure life insurance with no savings feature. And that's a perfectly fine way to get life insurance. It can be, at least in terms of premium outlay, can be the least lowest amount to pay and fund life insurance. On the other hand, if someone is interested in some of the savings features, investment component, then we really move into this second category. Instead of term life, it'd be in the what I like to call cash value. And within cash value, any life insurance policy that would have a savings component as opposed to term, I like to lump that into cash value. And so things that you've heard of like whole life, that'd be kind of the traditional cash value policy that's been around for decades and decades and decades. And all these cash value policies truly are really nothing more than the term insurance that we just talked about, coupled with a savings component. And so it's still life insurance, and that's what the term is, but you combine it with some savings in different ways to get these types of coverage that we call whole. You've heard of universal life, variable universal, and then several other kinds of specialty products that some of you have likely heard of as well. And so just to get a handle on some of these different ones, let's move to the next slide if we can, and I'll ask just a question here to get you thinking about this, and some of you will have experience with this at work, but what type of life insurance do you think people would typically receive through their employee benefits at work? And so as you think about your benefits package at work, and I give you a few choices there, so the kind of straightforward, plain, simple term, whole life or universal life, and you certainly could get any of these, but by far the most common that people would typically receive as an employee benefit would be that first one, the kind of pure term insurance, no savings component, and it could be a small amount, you know, 10,000, 20,000. You can actually get up to 50,000 paid for by your employer, tax-free, of term insurance. And so often employers will do that, but above 50,000, there's actually some taxes on the value that the employer would pay for it. And so, okay, just to kind of mention that. So term insurance is what we'll talk about first. And as we hinted at a little bit earlier, the term refers to a period of time, and so it could be, I don't have one listed there, but it could be 1 year, 5, 10, 20. Occasionally you'll see an insurer offer a 30-year term, but usually 5 or 10 or 20 years. And at the end of that time period, as I said, you could choose to renew if you still wanted to keep the coverage in force, but you'd renew at a higher premium. As we said, no cash value, and really it's for the beneficiary. So if something would happen to us, somebody depends on our income, and if we are not around to keep generating that income, then we'd want the amount of life insurance, the policy value, to be paid, you know, either in a lump sum or installments over the beneficiary's lifetime, or in other ways that we can choose upon our death. And so, as we hinted, as we get older, the chance of death increases, and so the premium would tend to increase with age. It's renewable, as we said. And then one nice feature is that a term contract that doesn't have a cash value or a savings component often is convertible into a cash value policy that would have a savings feature. And so if at some point down the road we decide that, yeah, we would like to utilize the savings features and investment components of life insurance, typically there'd be a feature to convert that policy. So if we look at a graph on the next slide, this first curved line, kind of the light blue line, is just illustrating, it's labeled there up in the upper right-hand corner, the mortality curve. And so if we just plotted kind of how many deaths per 1,000 people, and so actuaries who think about this stuff every day like to think in terms of, well, how many people are not going to make it through the year at various ages. And so we could start at age 20 there at the left at the X. You could start at any age, but at younger ages, maybe 1 out of 1,000, 2 out of 1,000. As we get into our 30s and 40s, maybe 3 or 4 out of 1,000 people would be expected on average to not make it through the year. And so, you know, fortunately, the probability of death, the mortality rate is very low. especially at the younger ages. But as we get older, that mortality rate increases, and so that's what that blue line is indicating. And so the price for term life insurance would, in general, follow that light blue line. So that'd be for term. To contrast that with cash value pricing, if, as we thought about this, if we said, you know what, I'd really prefer not to have an increasing premium as I get older, you might think to yourself, I'd rather, in a sense, pay a little extra when I'm young, and in a sense not have to pay as much when I'm older, and in that sense level out the premium payments. That's what that darker flat blue line represents. And so and this is really what we do with the insurance contracts where we do have a cash value. In a sense, we just pay more than we need to for the pure insurance, and then that extra premium gets allocated to the savings component. And so over time, you can see that we pay a little extra every year, and that's what funds the savings component, and that's what allows us to maintain that level premium even as the risk of death increases as we get older. And so in a sense, we quote overpay at younger ages and then underpay at later ages in a cash value policy, and that's what gives rise to the savings component. And so again, term life, perfectly fine way to do it, as is cash value, and it really comes down to a personal preference for what somebody would want to choose. Okay, and then on the next slide, we get into kind of the first type of cash value life insurance. So the very traditional, been around for decades and decades, what likely everyone's heard of, the traditional whole life insurance. And so it kind of gets its name from the idea that once you buy it, you would literally hold this policy forever. So for as long as you live, for your whole life. And by paying that level premium, that's a little higher than what we, quote, need to when we're young. By virtue of that, we accrue a cash value. The level premiums are what give rise to that cash value. And then just to mention one of the fees is as we build up, you know, $20, $30, $40, $50,000 inside this policy, we can actually access that money in terms of what's technically a loan to ourselves from the policy. And so that can be nice if we're looking for some liquidity, and we wouldn't have to necessarily go to a bank. We could just access the funds within our life insurance policy. The next type of life insurance is a little newer, and so it goes back to the early 1980s, and some of you will remember interest rates back in the 80s were, you know, much higher than we've seen in the last 10, 15 years. And so interest rates on government debt were 14, 15, 16%. So you could literally lock in 15% returns on basically risk-free government bonds for many years back in the good old days, in a way. But that gave rise to the question of, well, what am I, you know, if I have this savings component within whole life insurance, what am I earning on that life insurance policy savings? And it was rather difficult for consumers to know or see the rate of return within their whole life policy. And so for many reasons, but one of which was to make it more transparent, the rate of return on the savings component within your life insurance. That's what really gave rise to universal life. And so E.F. Hutton, a company you may not have thought about for a while or heard of for a while, actually had this product sitting on their shelf back in the late 70s and early 80s. And so they were the first to really come out with what we now call universal life. And so essentially it just tries to separate where every penny of our premium goes within the life insurance policy. So it separates the mortality part, the protection part, it separates the savings, it separately identifies exactly how much the insurer is charging for expenses. If market interest rates are 15%, then often consumers want to see an interest rate that their life insurance policy is paying them, somewhat close to that. That actually gave rise to, as you can imagine, some problems back in the 80s when life insurers said, oh sure, we'll credit your account with 10, 12, 14%. And if you start illustrating a life insurance policy earning 14% for 30 years, all of a sudden you've got a lot of millionaires who don't have to pay premiums anymore, and that can be great. But as it turned out, of course, that was a risky proposition for insurers in the sense that they couldn't sustain those kinds of interest rates. And so the interest rate is very transparent, visible, and insurers have gotten much better, and consumers are much more aware of reasonable, sustainable interest rates to keep expectations in line. One of the nice things is that premiums are very flexible. Increase them, lower them, as long as there's enough money in the policy, you don't even have to pay the premium. Like we mentioned for whole life, you can access the cash value. You can cover additional people on the same policy. But as we mentioned earlier, if the interest rate ends up not being as high as what we expected, and if we don't pay enough premiums, then there's a risk that the policy won't have enough premium in it. There won't be enough savings, and we either might have to increase the premiums or the policy may lapse. And so most folks would say there's a little more risk compared to whole life, and it really comes down to adequately funding the coverage at a reasonable, with reasonable assumptions. And so that's the first slide on universal life. The next slide just goes into a little bit more detail about the flexible premium. You can increase or decrease the death benefit. Literally, we're going to show in a column format where every cash flow goes, everything into the policy, everything out. There's literally a stated interest rate. As with any long-term financial product, if we want to quit early, there's often a surrender charge. And then more of a technical detail, we can get an option A where the death benefit stays level, or some people might prefer an increasing death benefit, and that'd be option B. And so the next slide shows what I was talking about, where literally if you were talking to an agent or you got an illustration online, it would show you in column format, so very much like a spreadsheet. And like we mentioned, universal life came into vogue back in the 80s when people started playing with their personal computers. And so this is really what people were starting to want and how people were thinking. And so if in year one you put in $500, the insurer deducts $100 for the mortality charge, deducts $20 for the expense charge that year. That leaves $380. They say, for example, they're going to credit that with 6% interest. That sounds pretty good in today's world. $380 plus 23 would leave 400 for cash value, and on and on. And so it really just shows you very transparently how the policy works and where every dollar goes. On the next slide, I'll just very briefly mention some people might like to get some equity exposure through their life insurance, and so get some exposure to some stock markets, and so insurers also then introduced variable life, and that's essentially what variable life would do, is rather than the insurer completely directing the investments, you would actually have some discretion over where the investments went in terms of mutual fund, equity-based accounts. The next slide shows a slight twist on that with a combination of variable and universal. And so kind of the attempt is to get kind of the best of both worlds with a VUL policy. And so on the next slide, you might be thinking, okay, there's all these different kinds of life insurance. Which is the best? And so that's a natural type of question, and one that people have been asking for a long time. Ex post, you can certainly look at a particular policy, a particular insurer, and how high their dividends were, how high their interest rates, credited rates were, how they treated their policies. Ex ante, though, kind of beforehand, the thing that's probably the way to think about this is in principle, term, whole life, universal life, all these types of policies are inherently good, fine. They're all policies that you can consider. And it really comes down to what an individual would want to do. And so if you say, yeah, I really want to take a conservative approach with some of my savings, then you'd go with a well high-rated insurer that has a track record of good credited interest rates or policy dividends. And as part of this question, I think the important thing to say is that there is a lot of variation across insurers in terms of price. And so as with any product, it really does pay to shop around. But in terms of term versus whole life versus universal life, my perspective is that all three are good and fine, and I wouldn't recommend against any of those, but you really do have to shop around, or should shop around, and find a company that has a good track record of being competitive in terms of price and then financial strength. Okay, this next chart just kind of summarizes, and as Jennifer said, this will be available to you later, so I won't spend a lot of time on this, but in terms of various questions and factors, here's a table that you can refer to later that might answer some of your questions about how these contracts differ.
Thank you, Jim. Before we transition into some discussion about annuities, a couple of things. Want to first remind folks that we welcome questions. So if participants would like to ask a specific question at any time, a very simple process, just type it into the dialog box in the GoToWebinar interface. We'll make sure that we get that to you. And on that very topic of questions, Jim, a webinar participant notes that he's seen a presentation on 60 Minutes about life insurers and something called the Social Security Death Master File. Wondering if you might take a moment or two to chat a bit about that.
Oh, sure. That's interesting. So I'm glad they were able to catch at least one of the episodes. There were actually two on this topic, one about a year ago and then one maybe 6 months ago. And so it might have been the one from a year ago that highlighted so in a nutshell, the Social Security Administration keeps a database of around 90 million people who have passed away. So there's names and Social Security numbers. And of course, what's supposed to happen is once somebody passes away, their name and Social Security number gets listed there. The first 60 Minutes piece had highlighted that sometimes you might get listed there, but still be alive. And so it was a very interesting segment about that can create some challenges if you then go to your bank and try to make a withdrawal, and the bank says, well, you're dead. And so that was that one. The one 6 months ago highlighted more of the issue that what the caller might remember was referred to as the asymmetric use of this database from the Social Security Administration, where some insurers would use this database to help identify people who had passed away that had purchased annuities, so retirement income from the insurer. And some insurers use that database to identify people who had passed away in order to then stop paying retirement income to someone who has passed away. And so that's all, fine and well. What some life insurers were criticized for is that, hey, if you can use this database to identify people who have passed away to stop paying them annuity income, shouldn't you also use that database to identify policyholders whom you have sold life insurance to, who maybe their beneficiaries have not filed a death claim yet, but if you know that they've passed away, maybe the life insurer should proactively reach out and notify beneficiaries of the policy and make arrangements for the death benefit to be claimed. So a very interesting segment, both of those shows. And there's actually been a number of insurers, a little bit over 20 insurers, and several states. And actually, this is actually a very current issue in the sense that many states are drafting and actually have drafted some legislation to deal with kind of the wider topic of unclaimed property. And so in this context, life insurance benefits that aren't claimed, possibly because the family doesn't even realize that there is a life insurance policy. And there have been and are very specific rules that insurers follow in these situations. But the 60 Minutes segment definitely highlighted some of the issues that arise in that. So great question, and I appreciate it. And that I think is a nice segue, since the Death Master file that the questioner asked about relates to life insurance and relates to annuities. And so with that, I guess I'll go ahead and start on the annuities section. And so we started off a little. Yeah, you're welcome. Talking about the baby boomers and the proportion of the population over 65. So it's a great thing that people are living longer. About every 3 years in the last 100 years, we've added a year of life expectancy. And so 100 years ago, life expectancy was closer to 50. And through medical technology, exercise, diet, and so on, we're adding about a year of life expectancy every 3 years. That's great until you start thinking about well, I want to retire at 55 and I might live to 100, and how am I going to pay for that? And so like we touched on a little bit ago, the Social Security system, Medicare system, that presents challenges there, as well for our personal finances and within our families, that makes some challenges as well. So on the next slide, we talk about really the risk that arises here. So let's just say we've worked and we've saved $1 million. So whatever amount we have, let's just call it $1 million. That's great, but now we have to live on that, and we might live a really, really long time. And of course, the risk is we can invest that $1 million and take out, some of you may have heard of the 4% rule. So don't take out any more than 4% of our nest egg in a year, and that should give us a fighting chance not to outlive our assets. But if investment returns and interest rates are low, like they have been in the last several years, that makes it really hard to stretch $1 million over a long time. And so we might not live forever, and we won't, of course, but even at age 65 in the U.S., men are expected to live another 16 years on average, women on average another 20 years. And of course, once you reach age 81 or 85, you can add another 8, 9, 10 years on top of that. And so life expectancy at birth is one thing, but once you reach that and keep going, you keep adding more and more years. And so about 1/3 of women and 20% of men today are expected to live even beyond 90. And so, and actually the first Social Security recipient, Ida Mae Fuller, who received her check back in 1940, paid in $25 to Social Security and received about $21,000 over the next years of her lifetime. She retired at 65 and lived to age 100, so even way back then. So that's the risk. And so on the next slide, we talk about life insurance is to help us address the risk of dying too soon, the mortality risk, whereas annuities really take the opposite side of that and try to address the risk of living too long, so-called longevity risk. So it's a great thing to live a long time, but it's probably going to take a lot of resources to do that. And so I like to mention what Oscar Wilde says. He thinks it's even better to have a permanent income than to be fascinating. And so he was really worked up about these annuities. And so he's got something to say about everything. And I was glad to see he talked about a permanent income as well. And that's really, on the next slide, what we were talking about. The purpose of annuities on that next slide is really to provide an income that cannot be outlived. And so the basic idea is for some amount of money that we would be willing to part with, let's just call it $100,000. So if we give the insurer $100,000 at age 65, that insurer would say to us, thank you very much, and in return for that, we will pay you, and we will promise to pay you about $700 a month or $8,400 a year for as long as you live. And so that's exactly what we're trying to do, is lock in a permanent income that will keep showing up in the mail for as long as we live. And so on the next slide, I have a question for everybody. So think about the private annuity market, not group insurance, because the rules are different there. But for every $100,000 at age 65 that we would give to an insurer, who do you think would or should receive more receive a higher monthly income. So women receive a higher monthly income, men a higher income, or you might think, well, let's just make it the same, and that's fine. Actually, within a group employee benefits context, answer C would be the right answer. So we have to, by law, provide the same income. But I'm sure many of you are thinking, okay, women on average live longer than men. Men die sooner, and so for the same 100,000 at age 65 that we would give an insurer, since men die sooner, that would be the answer. So men would receive fewer monthly income payments from the insurer for that 100,000 than women, and so men would receive a little bit higher monthly income. Okay, so digging into the annuity contracts, then you can think about, obviously there's an insurance company who makes this promise. There's the contract owner, the person who you typically would be the buyer, the person who writes the check. And then thirdly, there'd be the person who's insured under the annuity, and that's what we typically refer to as the annuitant, the person who would receive the monthly income. The owner and the annuitant can be the same person, often are the same person. And then one other party, potential party to the contract, would be this beneficiary who, if the annuitant would pass away, we might designate then someone to continue receiving that monthly income, even if we would die, pretty soon after starting our income. And so just to mention those. On the next slide, I try to give you just a feel for what monthly income might be at certain ages. And so you can see that $703 at age 65 in the column that's headed none. And so what that means is there's no kind of minimum guarantee. There's none. And so if you want the maximum monthly income for that 100,000 that you paid the insurer at age 65, that's what you would get. So about $703. On the other hand, if you wanted the income to start at a younger age, backing up to age 60, that 703 would be reduced quite a bit, down to 598, and then so on. On the other hand, if you're willing to wait to age 70, then it goes up by a fair bit too. The other columns illustrate the monthly income that someone would receive if they said, well, I'm really not comfortable, in a sense, forfeiting my 100,000 if I would kind of die early. And so someone who wanted a 10-year minimum guarantee, 10 years of monthly income, if you wanted that, you can see you'd give up, you'd go from $703 down to $645. But even if you died after 2, 3, 4 years, that option, the 10-year option, would mean that the insurer would continue making those monthly payments of $645 up to a total of 10 years, even after you've passed away. And so those columns, they provide smaller monthly income, but they come with a minimum guarantee. And so a lot of people will choose that. And so those are the main concepts I wanted to touch on with annuities.
Thank you, Jim. Time is tight, questions abound, and I know we want to spend some time talking a bit about health insurance plans, but let me pose one question that's been submitted on this topic. Ask for your reaction to it. With respect to annuities, can you talk about what direction these monthly income amounts have been going in over the past several years.
Oh, great. So yeah, if we could go backwards one slide, I think, back to that table. These slides, and I'm not sure if we can actually. Yeah, there we go. Thank you. So the 703, and I hopefully all the participants are thinking about this, and even just what we've talked about today and what you knew before. When you start to think about, okay, people are living longer, and you might even throw in there that investment returns are pretty hard to come by. And so, but especially the first one, as people live longer, these monthly amounts are and have been going down. And so you would have to search high and far. I'm not saying you couldn't find that, but that type of number would be excellent in today's market. And those numbers have, to answer the question, definitely been going down as people are living longer and as investment returns are harder and harder to find. So great question.
Thank you, Jim.
Absolutely. Appreciate it. So on the health insurance, as everybody's aware, the 15, 16, 17% of our $18 trillion economy that goes toward health care, health insurance. It's a big portion of the economy, an extremely important part, and we will talk a little bit about the Affordable Care Act within a broader context, but that's I'm sure on the tip of everybody's mind, and there's been a lot of changes driven by the 2010 ACA, and so I guess as a precursor to getting into some of the nitty-gritty there, I'll mention on the next slide really how we got to where we are is very, very dependent on what we've had in place for decades and decades. And so the vast majority of people got and continue to get their health insurance in the U.S. through group plans. And so one of the reasons for that is our tax code. And so just like salaries are a deductible expense for companies, so are employer contributions for employee health insurance. So corporations will deduct those. The big thing, though, driving group health insurance is that unlike salary, where we do pay income taxes, of course, we are not taxed on the value, federal or state income taxes or Social Security tax. So a big tax advantage to receive value through health insurance through our work. And so if we have a $10,000 or $20,000 health plan through work, the federal government doesn't say, oh, we want 30% of that in income tax. That may change over time, but it's a very tax advantaged type of employee benefit. So that's a major reason for the existence of our employer-based health insurance system. In the last presidential election, there was some talk about perhaps taxing a portion of the value of group health insurance. That basically didn't go through. Some of you may have certainly heard of what's referred to as the Cadillac tax. Originally, that was going to kick in 2018. Now I think they're thinking about implementing that more in 2020, and we'll see about that. But that would start to impose a tax on the value of some of these group health insurance benefits. And so when we think on the next slide about some of the traditional health insurance plans, typically based on a fee for service or some type of indemnity type of arrangement, either for individuals or groups. The next slide mentions, of course, the long-time existence of Blue Cross and Blue Shield plans. I won't spend too much time on those. The next slide mentions the managed care plans. And so just like the Affordable Care Act, one of its stated goals was to try to get a handle on bending the cost curve. And so health care costs have been higher than increases in the cost of living. The general cost of living, if that's 3%, increases in healthcare have been 5, 6, 7, 8% for decades and decades. And so everybody wants to get a handle on trying to rein in ever-increasing costs. And so managed care types of plans, of which there are many, try to get a handle on those. So try to negotiate with provider fees. Sometimes that ends up with lesser consumer flexibility, not always. But then there's a certain coverage of standard services within these managed care plans. And so the next slide, I don't think I'll go into too much detail, but just to mention here that there's really two pieces of this legislation. And so the ACA tried to work with an individual mandate and expand Medicaid coverage to try to get more people covered and contributing to health care and health insurance. And so on the next slide, we detail some of these specific components about everybody is supposed to have coverage or pay a penalty. Insurers had to adapt to some new rules about no denial of coverage or higher premiums for existing conditions, changes in terms of lifetime coverage and elimination of lifetime limits, keeping children on plans until they're 26, and then offering coverage either through traditional ways, through groups, or through federal or state exchanges. In terms of those exchanges, on the next slide, you've heard of the metal tier plans, so the bronze, gold, platinum, silver. The pie chart there shows that for people who purchase through these exchanges, the silver plan is where most people are going. It's a 70-30 type of sharing arrangement where the insurer covers 70%, the individual or family would pay 30%. There is still some underwriting that insurers use, of course, so age, smoker status, geography, size of the group that enrolls with you, and then they can vary across insurance companies. And so the idea was to try to generate competition, but within this new format and context. And so the next slide refers back to different types of these various managed care plans. And so again, I won't go into too much detail, but I think most everyone's heard of these. HMO, the next slide with the PPO, Preferred Provider Organization. The next slide, just another variation of the EPO, so these exclusive networks. Medicare on the next slide for folks over 65 and over. And all these really are a big part of what we kind of collectively call the health insurance market. So companies have a big vested interest in this since companies pay for the majority of healthcare expenses for their employees. The government, federal and state, have a enormous interest in quality care and trying to get a handle on costs. The next slide talks about consumer-directed health plans, where, and this has been the biggest wake-up call and surprise, unfortunately for many people, in that now many more people have coverage, but the nature of that coverage has changed dramatically, such that even if someone's premium hasn't gone up too much, they're surprised to learn that their deductible that they have to pay before the insurance, actually kicks in and starts paying. That deductible can be a couple thousand, a few thousand, all the way up to 7,000 roughly for individuals, and even 14,000 for families. And so what used to be often covered, by insurance in the early dollars, now much of that has been shifted to the pocketbooks of consumers. The goal, of course, is to motivate people to be more active shoppers, as opposed to just accepting and often over-consuming, and try to get people not to over-consume inefficiently resources allocated to healthcare. So, obviously we could talk for days about any of these three topics, but just kind of a big picture overview. The last slide just provides a little summary that we touched on life, annuities, and some of the various health insurance plans and markets to cover these medical expenses.
Jim, I thank you very much. It's been an informative session. I know we're up against a time deadline, but let me take a moment to pose one quick question to you submitted with respect to the discussion on health. Are you able to talk for just a couple of minutes about how deductibles in health insurance work and how big they are?
Yeah, so super question, and I appreciate it. This really is, I think, one of the sticker shockers that millions of people are starting to realize, that now that deductibles aren't, 200, 500, or even 1,000, they're much more in the couple, few thousand. By law, they can't be above certain amounts, but they can go up to close to 7,000 for an individual, close to 14,000 for families, and quite literally what 5 or 10 years ago would have been paid for by insurers now comes first out of people's pocketbooks before the insurance starts to pay. And so we didn't mention too much about these things called health savings accounts. But that's, of course, a way to set aside income pre-tax into an account that we can use to then pay medical costs that that we count towards our deductible before the insurance kicks in. And so understanding how those deductibles work, essentially that we pay for every medical expense up to the deductible. And then after that, we're paying, 30%, 20%, 10%, depending on the type of plan that we chose. And so that can add up to a very big number. But again, the goal, I think, was laudable in the sense that we want to give consumers more skin in the game and not inefficiently overconsume health care. But by doing that, the real cost of health care and the various expenses becomes much more visible, and we feel it a lot more through these deductibles. And so not everything with the ACA is going as planned. Some things have been very good, access, but of course there's a lot of issues that would need to be worked out, and time will tell if those get worked out.
Understood. Thank you very much. We are out of time. Very informative session, very engaging. Let me take a moment to thank you, Dr. Carson, for your participation today. In addition, we thank our attendees for joining us, and remind folks that the fourth and final seminar in this four-part series is coming up in the days ahead. Jennifer Burnett, our friend at CSG, will share some information on that program along with a couple of final thoughts, so I turn things to Jennifer.
Hey, thanks, Frank, and thank you, Dr. Carson. As I mentioned at the start, this webinar was recorded, and it will be archived in the CSG Knowledge Center and by the Griffith Foundation. So if you missed any part of the program, or if you'd like to pass it along to a friend, it will be available in the next few days. The final webinar in this 4-part series will be on October 25th at 2 p.m., so 2 Tuesdays from now, where we're going to hear from Professor David Russell from California State University, Northridge, on the topic of insurance regulation and legislation. So on behalf of the Griffith Foundation and the Council of State Governments, thanks so much for joining us today, and have a good afternoon.